from Kansas State University, this is Agriculture Today. Eric Atkinson with you. Here's today's lineup. Out of Oklahoma State University, Derrell on the cattle markets. He'll talk about how the current price trends relate to the geopolitical turmoil abroad and the increasing economic stress in this country. And he'll look at the cattle herd inventory implications of the drought either worsening or easing up this year. Then K-State's Gregg Ibendahl with his new analysis of oil price trends relating to the war in Ukraine, what they imply for agricultural producers. And K-State's Jenny Ifft continues her series on price risk management for you cow-calf producers, this time with a closer look at the indemnity payout expectations from Livestock Risk Protection coverage. That's what's ahead on this Agriculture Today. Welcome once more to another Agriculture Today. Glad to have you listening in on this Monday. Well, loads to talk about on the cattle market scene, and helping us out once more is Derrell, livestock economist at Oklahoma State University. Derrell will spend the better part of our time visiting today about drought scenarios and what may happen with inventories of cattle around the western part of the U.S., including the Central Plains. The fed cattle market last week lost some ground. You might speak to that.
Yeah, the market pulled back a little bit. I think, it could be a combination of things. It may be partly seasonal. We're close to a seasonal peak normally, and we may have peaked these markets a little bit early. Some of that is related to current events in Europe and other places that have put some pressure on some aspects of the market. So the market has pulled back a little bit. I don't think this is a major, trend or really an indication of a major problem at this point. But, again, there's just so much turmoil in the markets in general right now with the current events in Europe combined with the, sort of macroeconomic conditions that we're looking at. And when you look at higher energy prices, higher fertilizer prices, higher feed costs in particular, I think there's just a kind of a general pull back in these markets a little bit, but not necessarily completely losing their footing at this point.
The feeder cattle markets in Kansas, anyway, were somewhat decidedly lower. You note that what wheat pasture cattle there were are probably now in the market and have moved by this point?
Yeah, I've been spending quite a bit of time in auctions collecting data recently for a project we're working on and seeing a lot of yearling cattle come through. I think many of the wheat pasture cattle started dribbling in as early as January, all through February. By now, mid-March, we should have them all in, and I think we do have the majority of them in that are going to come in. And the feeder cattle markets have pulled back a little bit in the last couple of weeks. I think you can clearly lay that at the higher feed cost. The pressure on, cattle futures, both live and feeder cattle futures dropping puts pressure on these cash markets. So, again, it's quite likely, I think, on the feeder cattle, particularly the lightweight feeder cattle, that maybe the seasonal peak happened about 2 weeks ago in late February. And although, it's not too late to have another run up if conditions were to improve.
Well, on the product demand side, boxed beef, higher week last week. Again, that's a reassuring sign here if consumers will continue to pay those higher prices.
That's right. The boxed beef market has kind of stabilized a little bit and actually increased slightly over the week last week. Again, it's more of a stabilization from some of the weakness we've seen over the past several weeks, I think. And you see that in several of the product markets if you look at specific wholesale cuts. And so I do think these markets are stabilizing a little bit. Obviously, there's a lot of concern about inflationary pressures, higher energy prices potentially impacting beef markets. So we'll watch that going forward. But right now, it looks like that market still has pretty strong footing.
You alluded to earlier the conflict in Ukraine. Of course, that is front and center in the headlines and on everybody's minds. Do we see, or can this connection be made, any direct repercussions on domestic beef demand here in the U.S. from that turmoil in Ukraine?
I think it's too early to see, for sure a connection. We already had higher prices. We had inflationary pressures in the market. We had higher energy costs, so consumers were paying more for gas. Obviously, that has, accelerated dramatically in the last couple of weeks. So, I would anticipate that we will be able at some point to sort of lay some additional impacts potentially on beef markets and beef demand to these events. I think it's a little bit too early yet to say that for sure, because it's really more of an extension and an acceleration of trends that were already at work in the marketplace.
Mm-hmm. Derrell, you put together some articles recently very important to our situation at hand as we push deeper into 2022 now. The drought conditions, which have plagued parts of the West in recent years, the northern plains last year for sure, now certainly asserting themselves in the central and southern plains in particular. And you have gathered some thoughts here on a couple of scenarios. If the drought worsens in these areas and becomes broader, or if the drought starts to abate here as we get into the later spring and then summer months. Let's talk about the first scenario. If we see drought intensify and widen, what does that mean in as far as cattle numbers?
I think we could see some pretty serious consequences for cattle markets. Part of that is the fact that we, as you noted, parts of the country have been in drought in 2021 and some parts even all the way back to 2020. So, a lot of these areas, producers are really, they just don't have any resources left at this point. And we know in the northern plains and some other areas that hay supplies were very limited and so on. With the drought continuing in those regions and now expanding into some other areas, we could see a lot of forced changes, drought-forced liquidation happen here in the next 3 to 5 months if conditions don't improve. And that's on a big enough scale. I mean, we're talking over half of the U.S. beef cow herd potentially impacted by drought at this point. And so, that would clearly have some market implications if this thing persists and stays as widespread as it is right now.
And would it be most noticeable in areas that had not really experienced this harsh drought the last year or so, that we could see inventory reductions in places like Oklahoma, Texas, Kansas really pick up here?
Well, in some sense, yes. I mean, obviously, we maintained our numbers better than the rest of the country in general last year, or at least better than the regions that had more drought last year. So you could see a lot of consequences. But those regions that had drought, many of them did do some herd liquidation last year, but again, with no change in conditions, even, more restrictions on hay supplies and so on. I think we could see pretty widespread liquidation across regions that have already been in drought, as well as these sort of newer drought regions. All of it could get to be pretty serious. And that's really a consequence of the fact that we're in a drought in the wintertime and going into spring. That's the worst possible drought scenario. A springtime drought, you just don't get any forage production potentially. And if that happens, then the consequences get very severe very quickly as we move, from April, May, June, in that early growth period. That's a really critical forage time. And if we lose that, then we're really going to be behind the eight ball probably for much of the year.
And what are the longer-term implications of that if that comes to pass?
From a cattle cycle perspective, again, cattle numbers peaked in 2019. We were liquidating, but at a very modest pace until last year. And the drought last year and the additional cow slaughter that we saw last year accelerated herd liquidation somewhat last year. So we ended up this year with the beef cow herd down 2.6%. And again, with what we're talking about here, we could see that number accelerate even more this year. That would push us lower. If you remember what happened in 2011, 2012, we took the cow herd much lower than we ever intended to because of drought, and that set up a scenario of unexpectedly high prices following that. I'm not saying that'll happen this time, but I think it's a scenario that we want to keep an eye on because it wouldn't take a lot of drought in 2022 to push us significantly lower than we intended to be in terms of our overall cattle numbers.
Then about that other prospect, if the drought would ease and we see some rainfall, we see improvement in forage production and so forth, the question that comes to mind really, will that be enough to prompt actual additions to the herd, some modest level of expansion?
We've had higher prices coming into 2022. Of course, prices were higher on average in 2021. Our expectations are for higher prices. And so if that translates into higher profitability, which is a real question now with input costs really moving into the frame a little bit more. But assuming that the higher prices at some point in time translate into an incentive where the industry would like to expand, and that'll probably happen. It just may not. We don't know when. But if the drought conditions abate, could we do it in 2022? I think it's pretty limited. Given the number of replacement heifers we carried over, they were down 3.3% coming into 2022, beef replacement heifers. And as I run the numbers, I have a hard time doing more than holding the herd steady at best. Even if we have good forage conditions and no real incentive to liquidate, I don't think we can put together much, if any, growth this year. I think the best we could hope for would be to kind of hold the herd steady or perhaps maintain a very modest level of additional liquidation in 2022.
Well, it's going to be an intriguing year for sure. Lastly, thoughts on the market trends this coming trading week?
Well, again, it's springtime, so, we're kind of in that peak season. Again, we're watching the box beef. It's actually about time for box beef to start trending up ahead of, sort of in anticipation of grilling season demand and some wholesale buying there. The hamburger market continues to be very strong for sure, but we'll see some additional buying. So that will be in place. That should help support the market a little bit. Obviously, we're watching things like gas prices very closely right now to see what that does to consumers and their discretionary dollars. So I think these markets will kind of, they're probably okay right now to sort of hold steady, but it may be hard to put together much in the way of improvement at this point in time.
Always appreciate your insight, and we'll catch up with you again in a few weeks. Thanks, Derrell, for your time and your comments.
Yeah, you're very welcome.
Derrell Peel, livestock economist, Oklahoma State University, on the cattle markets. We'll be back on Agriculture Today. Agriculture Today continues now in the advent of the Ukraine-Russia conflict, obviously so high profile right now. One of the main results that has everybody talking, the impact on oil prices. And we're going to dig deeper into what that relationship actually might be and how it affects agricultural producers. Our guest now has been working up information on that conflict and influences on various crop inputs, oil, and fertilizer, which we'll talk about tomorrow. Gregg Ibendahl is a farm management economist with K-State Research and Extension. Everybody knows what we're talking about, Gregg, but we've seen the price of fuel for vehicles soar significantly. You have, in your write-up on this, some historical perspective on fuel prices you might share.
Yeah, so we kind of got used to oil and gas kind of being in the $2 to $3 range there for a long time, and suddenly we're at $4.20. I think was the latest price I've seen for gas. So now we're in record territory, which seems really high. But if you go back and put the gas prices in terms of real dollar terms or in today's dollars, there have been some periods in the past where gas is almost like what it has been right now. But those have been probably 7 years or more in the past. I think back in 2008 we got really close to a real dollar value, almost $5. Now that was also associated with a really bad recession too. So, the question is the gas right now, is that going to lead to another recession?
And all are looking to the relationship here of that to oil movement in the marketplace, and with Russia being a heavy oil producer, what that's really lending to the domestic fuel situation here in the U.S. For perspective here, our reliance on Russian oil, although we now have banned Russian oil imports into the U.S., but what has that been typically?
Well, it's a weird situation in the U.S. So not only are we a big exporter, we, I think, export like 100,000 barrels a day or something like that, but we also import a bunch too. And a lot of people think, well, why are we exporting oil when we're still importing oil? What's the deal with that? Well, it turns out all oil is not created equal. There are different types of oil, just like there's different types of wheat. So with oil, our refinery system in the U.S. is really set to handle a lot of this heavy oil, like what we used to get before the fracking took place, and really that's oil from Canada is kind of in that heavy category too. Those are more complex molecules of oil. They're harder to process. process. We have the technology in the U.S. to do it, so we're probably the world leader as far as the ability to process oil. So those heavier oils like we typically used to get out of the ground, they're good for making a bunch of other things besides oil and gas and diesel, because you can get a lot of the lubricants and that kind of thing, which is a big market for that kind of stuff too. So what's been happening, the new fracking technology, we end up with a lot of sweeter, lighter weight oil. That's easier to refine. So some of these other countries that have refineries, but they're not as sophisticated as U.S., we've been shipping that oil over there. Well, yet we bring in like Canadian oil that's heavier for processing over here. So it's a weird situation where we do both at the same time. But from a scheme of things, it works really well for what our system in the U.S. is set up to process. With that said, then, what is, as the numbers tell it, our reliance on foreign-sourced oil? Well, it has changed quite a bit. So if you can think back to the early 70s when we had the first oil crisis, some of you older folks may remember that. At least I certainly can anyway. We had gas lines and such, and we had moved to a point there was a lot of import of oil, and we were dependent upon OPEC to a high degree, probably about 50% of our oil thing. So we kind of had a recession at that point in time, and we relied less on oil. But then since that time, really oil imports really started increasing again. And at one point in the early to mid 2000s, we were about 70% of imported oil, which you think back now, that's really kind of scary that we relied so heavily on imported oil. Well, then fracking took hold. They discovered how to do this horizontal fracking where you actually drill wells sideways under the ground and fracture that shale oil on the ground. Turns out there's a whole bunch of oil in the U.S. that's trapped like that. Well, suddenly then we started getting a whole bunch more oil produced, and now we are to the point now where we're really importing probably about 15 to 20% of our total oil imports. So the percent, even though it's a lot still, I mean, it's way down over what it used to be. And if you break that down by exactly where those imports are coming from, and bringing it back to the Russia question, actually the Russia chunk of that business is relatively small. It really is, because we're getting, like I said, we're getting a lot of this heavy oil from Canada coming down, so that's a big chunk of what the oil is. But really, you got to remember too that oil is a fungible commodity. So oil produced in Russia looks a lot like the oil coming out of the Midwest or plains in a lot of cases. So it's hard to separate that. So even though we may say we're not going to buy Russia oil anymore, even though it is a small part, the fact that we're going to do that just means oil prices overall are going to go up higher. And really, even though we don't get oil directly from Russia very much, the overall effect on the prices is going to affect everybody. So, effective sanctions, and again, there's some debate whether you can actually even have effective sanctions with a fungible commodity like oil. Assuming that it does work, the whole world's going to pay higher prices for oil. Just for perspective, and your paper outlines it, we import, of our imports of oil, 1.5% from Russia, 64% from Canada, to your point. Yes, again, a lot of that's heavy oil, which we're set up to handle, so it works good to bring Canadian oil down here for processing and ship our lighter, sweeter crude off to other places that can't handle that kind of oil. There's another aspect of this we should weave in here, and that is, Gregg, natural gas as part of this complex here. And we do actually import some natural gas. Russia definitely exports it. How does that relate to our situation? Well, this probably relates more to the fertilizer side. So if we're going to be a nitrogen producer, which we are in the U.S., we have to have lots of natural gas and all the other things that use natural gas for. So that's a very versatile fuel. You can use it for, heating and drying and making nitrogen fertilizers and all kinds of things. So it's a pretty important thing. But, as a gas, it's kind of hard to transport, too, so you really need a good pipeline system. I guess you can actually liquefy it to some degree. So the U.S. is almost self-sufficient in our natural gas production. We probably import a little bit, but I think there's some room we could expand there if we had to. But again, Russia, they're a big player in all the energy markets. They produce well more than what they're using, and especially over in Europe, they're a big supplier of the natural gas used by a lot of the European countries. So to me, again, a successful set of sanctions would probably have a big effect on prices that they would pay over in Europe for heating for natural gas. And that particular topic will spill over into our next conversation tomorrow, as we'll look at your fertilizer analysis relating to the Russia-Ukraine situation. So the question at hand, again, back to the oil market, where are oil prices headed? Yeah, that's a good question because I'm a firm believer in the free markets and let them sort things out. And I think they have sorted things out to a little bit, although, again, we're still kind of trying to find exactly where it's going to settle. So, before this whole Russia and Ukraine thing happened, we were probably looking at oil that was I think we were probably under $100 yet. Well, the last couple of days, we have seen future prices hit 125. So there's already been a 25% increase in the price of oil just because of that. Now, whether that's the top end or not, that remains to be seen. The markets will figure it out one way or the other. People may not agree with how markets work, but they are efficient, and they do end up with a price that that everyone's going to agree that it may not necessarily be the best price, but it is a fair price because buyers and sellers are all agreeing on that. So my worst case scenario is I could see oil maybe going higher, maybe up to 150 possibly. Again, that's a little bit of a guesstimate. If you look at what the EIA, which is the Energy Information Group out of that for the government that predicts this kind of things, they really put a very wide range on their range. They were basically thinking it was going to top out at about 125, and we would see a slow decline over the next 2 years. I'm not really quite that optimistic, and they were actually predicting it might be about $80 after 2 years. I think that may be a little bit optimistic for oil prices. I think maybe that might be the bottom end rather than what the expected value is. So I look at that as our lowest end maybe, and then we're at 100 to 125 now, maybe add another 25 on that. So that's the range I'm putting on things at the current moment, and we'll see what the market says about that.
And would you concur with their thought that it will be a slow decline once it takes shape?
Well, yeah, that's a good question because it really depends on what happens with Russia-Ukraine. I mean, they'll come to a quick settlement, and then it probably would, but it's just going to drag on for years, and then probably not here. And Russia's ability to produce oil and gas, I mean, to me, sanctions have never really been all that effective just because oil is a fungible commodity. So unless we get the entire world not to buy oil and gas, I think you're going to have a hard time keeping Russian oil off the market. Now, the other question is how much of our Russia's oil increase is due to our expertise and with them helping them. We have oil companies over there that have certainly helping them with the technology to do that. Those folks pull out. Is Russia going to still be able to do that on their own? There are so many question marks about this remaining to happen. It's just really have a good handle where this may end up going altogether.
Your message to agricultural producers out there: plan to contend with these fuel prices for some time to come.
Yeah, I've always said the best time to buy oil and gas or diesel fuel for farmers is really probably in the wintertime because it usually tends to be a mini spike in the spring and in the fall. I think that's going to be the case now. I think if you missed your window to buy diesel fuel in early January, I think you're going to be stuck paying higher prices through planting season now. So I don't see much around that. The only good thing about everything with the way the harvest and planting windows work for farmers and the fact that we use a lot of bigger equipment and minimum till is that really the diesel fuel cost just by itself is not necessarily all that bad, about $10 an acre. So the fact that diesel price went up, really on the bottom line, I think I was looking at maybe another $6 an acre cost, which is not great, but it's not, not as bad as what you might at first think that it could be.
And as a matter of fact, you put together a companion write-up on the Russia-Ukraine conflict and the effect on the fertilizer market. Gregg, if you would, we'll have you back tomorrow and we'll look into that side of it.
Okay.
Appreciate you coming by. Thank you. Gregg Ibendahl, farm management economist, K-State Research and Extension. Again, this article we've been speaking of here on the Russia-Ukraine situation and the effect on oil prices can be found right now at agmanager.info. Have a look, agmanager.info. We'll be back. This is Agriculture Today. Closing out this Monday edition of Agriculture Today, it's the next installment in this series we've been presenting for you cow-calf producers on price risk management. Along once again is risk management specialist, K-State Research and Extension, Jenny Ifft. Jenny, now in this part of the series, we're into the ins and outs of Livestock Risk Protection, the coverage provided by the USDA Risk Management Agency. Today, you want to look at the indemnity side of the program here and how those tend to shake out. And you've looked at historical data as to how frequently indemnities might be paid for this coverage.
Right. So indemnities, if first of all, if you look at the prices for the insurance, they can go up quite a bit as you get to higher coverage levels. And one way to understand that is to look at the frequency and magnitude of payouts or indemnities. So if you look at the highest coverage levels, about 95% to 100% of the LRP expected price or the futures price, those high coverage levels could have indemnities about 50% of the time, about half the time. That's what we've seen historically, about 1 out of every 2 years. Right now, the lowest coverage level you can get for LRP is about 90%. Those coverage levels only see indemnities about 1 out of every 5 years, so much less frequent. Now, one thing I want you to think carefully about, though, is just because I'm saying it's 1 out of every 2 years doesn't mean it's going to happen exactly every other year. You could have a couple years with indemnities, and you can have a couple years without indemnities. The market is cyclical, and it's going to reflect that. It's not a consistent experience.
And you said that from the outset, LRP is to be considered for the long pull of price risk management, not for the short term.
Yeah, if you focus on indemnities in the years where they're really high, 2015, they were over $20 per hundredweight, so that could be $100 or more per head in 2015, which sounds good, but if you remember 2015, it wasn't a great year otherwise.
Talk more about how high those indemnities can go. What do the historical trends tell us there?
Right. So that $20 per hundredweight, that's relatively rare. We've only seen that once since 2007. It's that 2015 period. It's even relatively rare to see the payouts go over $10 per hundredweight. We saw it for a little bit in 2020, 2012. But it could also just be a couple of dollars per hundredweight as well. So relatively small price declines are also very common. So the experience can really go up and down. You know, prices, they really go up and down a lot. Indemnities really vary over time. So it's important to consider the average experience or the long-term experience as well. And so what we found looking at 2007 to 2021, at the highest coverage levels, so up to 100%, you could see net indemnities of $2.39 per hundredweight. So net indemnity is the indemnity less the premium. So over the long haul, that's over $2 per hundredweight that a producer is getting out of the program. That translates into about $13 per head if you're looking at a 550-pound feeder. That's about as far back as we can go historically. Again, those payouts are coming during low-price years or years with large price drops, but especially the higher coverage levels, you do see the producer coming out ahead. This is coming from the fact the federal government is paying part of the premium, so that's consistent with a lot of crop insurance products. The higher the price decline, the higher the indemnity.
We've been talking about historical trends largely here with the LRP, but there are details on the policies themselves that you want to get into, and that's what we'll do next week.
Yep, next week I'm going to sort of start wrapping up with here are some important policy details. If this is something that a producer is potentially interested, there's a few additional things they need to know.
Again, this series of articles that Jenny has put together on livestock risk protection and more broadly price risk management for cow-calf producers can be found at the agmanager.info website, and she's been drawing today from part 6 of that series. Take a look at that, agmanager.info. Jenny, we'll have you back next Monday.
Thank you.
She is a risk management specialist, K-State Research and Extension, Jenny Ifft. And that is our time for today. We appreciate you tuning in. Eric Atkinson for Agriculture Today over the K-State Radio Network.